I think that the US is slowly becoming more of a low trust society. And if there's eroding trust in the US, in the US dollar, in US treasuries, I think the other side of that trade is obviously gold. When momentum really kicks in, how dynamic it actually is, yeah. And we've seen this dynamic in silver.
The risk-free rate is always assumed to be U.S. government debt.
Yes.
I mean, that's just, nobody questioned what C was. Maybe today is different. Gold's at $5,000 and silver's at $100. We're at the Vancouver Resource Investment Conference, and joining me now is Ronald-Peter Stoeferle, founder or author of the In Gold We Trust report. Very interesting report that comes out every spring, and partner of Incrementum AG. And Ronnie's been absolutely correct on his calls for gold, but I believe gold and silver have run up even faster than a lot of people like yourself had anticipated. Welcome back.
Thanks for having me, David. Thanks for not butchering my name. You said it, Stoeferle, almost perfectly.
Okay, I'm learning after having worked with you for so many years. One can only fail so often. But thank you, Ronald, for encouraging me. What's encouraging is the price of gold and silver. What's not encouraging is some people at this conference giving presentations about taking profits now. And these are notable miners, notable investors in the space. And the question of whether or not the industry, the sector is topping is front and center on so many people's minds. So many people have come up to me personally and asked me, what have your guests been saying about this momentum? Is this the top? How would you approach this question?
I would say it's a bull market, not a bubble. Somebody said that Ross Beatty actually called
That's
gold
exactly it.
a bubble. I tend to disagree, and I think I would like to see. I mean, it sounds perhaps a little bit weird, but I would like to see a healthy correction over the next couple of weeks, because it's just been such a relentless move the last couple of months. But this also tells you that there's so much capital waiting on the sidelines that every minor dip is being bought. So, long story short, bull market, not bubble. I think there's an enormous amount of capital still from the fixed income side, basically. That was like a main part of my presentation here, saying, well, the 60-40 portfolio is dead. And we're seeing in the fixed income market it's like 170 trillion asset class. If there's just, tiny bits of that 170 trillion moving into hard assets, that's going to have an impact. And I think we're right at the beginning of that move.
Right at the beginning, even after gold's gone up 50% last year and then another 50% the year before?
Well, I would say gold is not a contrarian asset anymore.
Okay.
Yeah, I mean, that's crystal clear. I would say we're like, in football terms, we're like in the second half of this bull market.
Yeah.
We can go to overtime. We can go to penalty shooting.
Yeah.
But for me, David, the big question is this a normal cycle, or are we basically at the beginning or right in the middle of a remonetization of gold? And with all the price action, but also some sound bites by very prominent politicians and also central bankers.
Yes.
It seems to me that gold is coming back to its traditional role, which is like the monetary role.
There's an interesting chart here from one of your recent slide decks that you sent me. Debt math, gold price targets by debt coverage ratio. And you have this red line going up pretty much 45 degrees, extending from the green line, which is U.S. gold reserves in percentage of U.S. debt. And it basically implies that by 2055, which is only 20-something years from now, less than 20 years from now, we have an implied gold price at $96,000.
Based on historic gold backing of U.S. debt. So what we do is, I mean, let's face it, gold is expensive versus commodities, especially versus oil. But if you evaluate from a monetary point of view, it's still pretty cheap. So we're below 25% backing of the U.S. monetary base. Historically, we've seen in the 1940s, but also at the beginning of 1980, that actually more than 100% of the U.S. monetary base was backed by gold. So this is the so-called shadow gold price that we're showing. If you show the international shadow gold price, you can come up with even higher price targets. Van Eck just recently came out with a very interesting story, very interesting research piece where they actually did the same thing that we did a couple of years ago with this international shadow gold price. So you can up with 50,000, 100,000 gold price targets. Yeah, I mean we can play around those numbers, but from my point of view, the essential point is, if we're going back to some sort of a remonetization of gold, then it's still, I think, pretty cheap.
What do you mean by remonetization?
If there's some sort of a backing of the US dollar and or other currencies by gold. And, since 1971, we're living in the exception to the rule. So, if you study monetary history, we've always had some sort of gold backing.
Yes. When there was a gold backing, especially during the Bretton Woods era, because the dollar was backed by gold, there was a fixed price of gold. And so one could argue gold stability provided the backing. Since 1971, gold has climbed from a few dollars to now $5,000. Corrections in previous bear cycles have ranged anywhere between 40 to 70%. One could look at this and say, Ronald, this is a very volatile asset over the longer term horizon. It's not stable enough anymore to be an anchor for a gold-backed system. How would you respond to that?
Well, gold always has been the anchor, and since 1971, there's now suddenly volatility. So basically, it's from which perspective you're actually seeing it.
Yes.
But David, I think the really interesting thing for us as market commentators and analysts is actually the fact that gold has been like on a little stage previously where central bankers and politicians couldn't care less about gold. But now it's center stage. Now we've got Scott Bessent saying, I want to be part of a Bretton Woods moment. Now we've got the US administration openly talking about a revaluation of US gold reserves, from 42 to current prices, which would give them just an accounting effect of more than 1 trillion now. Does it solve all the problems? No. But there are things happening where I would say, well, actually, I think the US administration actually gets gold. And, my take has always been that the foundation of this bull market, of this secular bull market, is emerging market demand. This is roughly more than 2/3 of annual physical gold demand coming from China, from India, from the Arabic world, from Turkey, and so on. So this is like the foundation of the bull market. Then in 2022, with the sanctions against Russia, the Western world freezing Russian FX reserves, we had the additional driver being central bank demand. 4 years in a row of roughly 1,000 tons of gold being purchased by central banks. And now only lately, Western financial investors woke up and started allocating capital into gold. And I can tell you from we're fund managers, we're talking to institutional players. Most of them keep telling me, well, gold is already too expensive. We missed the party.
Yeah.
Goldman Sachs just had a study where they said large institutional clients above 100 million have on average 0.16% invested in gold and gold ETFs, which is 5 percentage points lower than in 2012. So I think, for this gold bull market to continue, we will need Western financial investors really waking up and starting to accept gold as a bond diversifier, as a portfolio diversifier. And if we're really going to see that, then we're still pretty early on.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colomag are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Colomag spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. I'd like to ask you about Bitcoin later on as well, but what we saw for Bitcoin is a shift of the holding base, of the investor base. Previously, when it first started its life many years ago, well, actually not that many years ago, 10 years ago, retail audiences, investors dominated the Bitcoin base. Now, central banks are thinking about buying it. The US government has a Bitcoin reserve. I read on the Financial Times recently that more than 50% of hedge funds globally surveyed now have some holding in crypto, up to 7% of their allocation on average. It's really shifted from a retail investment class to an institutional asset. Are you seeing anything similar with gold, where the institutional audience has shifted their perception of the metal?
Unfortunately not. And, gold is a very emotional topic, and you can see that at big retail conferences like here, many people treat gold as a religion, and it's, the solution for all our problems. We're asset managers, yeah. Our clients pay us for actually that we are having the sleepless nights, yeah, and not them, to take care of their hard-earned money, to manage risk. And I think that, this kind of a sober view on gold is something that is totally missing. And this is why we put out, big reports like the In Gold We Trust, just crunching the numbers and saying, a certain allocation of gold totally makes sense from a portfolio point of view. Mm-hmm. Let's say like 10 to 15% really improves your portfolio characteristics. And we came out with this so-called new 60-40 portfolio, yes, where we said, okay, let's say 15% physical gold as a strategic monetary insurance, but also 10% what we call performance gold. And this is gold and silver mining equities, for example. Then we said 10% commodities and 5% Bitcoin. So there's definitely a larger allocation compared to the traditional 60-40 portfolio to hard assets. And I think that now more and more people are kind of waking up and see, well, inflation is kind of sticky. We're still above 2%. Still, central banks, have already lowered interest rates. Perhaps the next inflation wave is around the corner. And I think if that should happen, if we're actually at the beginning of the next inflation wave, then I think we'll see more and more flows coming from, traditional investors. But our job again is to make a sober case for gold, and I think, the numbers speak for themselves. Gold has a CAGR of 9.4% since 1971. So gold is a fantastic portfolio diversifier, and really my mission is to get the emotions out, just show the numbers, create a strong case for gold, a strong, sober case for gold. I think that's kind of missing in our industry, unfortunately.
Given that the long end of the treasury yield curve is now correlated with gold, do you think gold is basically behaving like the new bond?
Yes, I think that's a good observation, and I think I read up about that. The 1970s gold bull market, and we had a nasty 50% correction from 1974 till 1976. But then at the very end, the majority of the demand was actually coming from fixed income investors. And there's some stories of bond fund managers. They had up to 30% physical gold in their bond funds. Now, currently, this is, I think, from a legal point of view, it wouldn't even be possible. But this, I think there's a strong analogy that there's shifts coming from, or that the majority of the future demand might come from fixed income. And as I've said before, that's still a huge asset class. And the big question is, and if you're having a look at the news, I think that the US is slowly becoming more of a low trust society. And if there's eroding trust in the US, in the US dollar, in US treasuries. I think the other side of that trade is obviously gold. And gold has built up this enormous amount of trust capital over the last hundreds and thousands of years. And if that's really continuing, this loss of trust, then again, we're probably not very early, but we're definitely not at the end of this bull market.
The real interest rate in the U.S. is rising, actually in most places around the world. In the past, the real interest rate was negatively correlated with the gold, going back to my earlier statement. Why do you think it's positively correlated now? When you just think about the rationale of why it should be negatively correlated, when you have real interest rates rising, you can have good risk-free, almost risk-free yield in the U.S. Treasury market, and you could, gather a return there. And then inversely, if the yield is low, you seek yield in other places. Now they're moving in the same direction. What doesn't make sense?
Yeah, I mean, it's a term premium, obviously, but it's also the fact that, inflation expectations are... I mean, if you're having a look at inflation expectations, basically everybody believes that we're going back to the old regime.
Yes.
So 2% will be the ceiling. But then I think more and more people actually realize, and those are the conversations that you have with people from the traditional asset management space after 2 glasses of beer or wine, when they say, well, we know that inflation numbers are significantly higher than officially announced. Yeah, so those, I call them closet gold bugs, who actually have a mandate to to deliver nominal returns. They realize that actually inflation will stay around for the next couple of years, because obviously we haven't talked about the debt situation. Just last year, first half of last year, 26 trillion more government debt. Those numbers are significant, and we've seen with Doge in the US that it's actually, it wasn't a big success to significantly lower the deficits. The US had a 2 trillion deficit last year, and it seems that we're now at the point where nobody cares anymore. Mm-hmm. We're at 40 trillion debt in the US in August of 2026. And I think that bond owners just, they are now living in this kind of new reality. But talking about bonds, I thought it was really interesting what Judy Shelton kind of recommended to Donald Trump, and they're pretty close, for the 250th anniversary of the United States, issuing gold-backed treasury bonds. I thought it was a very creative way, coming up with a 50-year or even a century bond with a certain gold backing. I wouldn't rule out that something like this is going to happen. So if you do that, and then say, well, if you're an institutional player, if you're the ECB, if you're a European pension fund, if you're a Japanese pension fund, actually, if you want to stay a friend of the United States, you will have to buy those century bonds that have some sort of gold backing. I think it would actually solve quite a lot of problems from the US.
Can you walk us through one more time, in your 2025 In Gold We Trust report, the gold cycle, the multi-year gold price cycle that you outlined in that report, and where we currently are in that price cycle? I would presume that the timeline has been shifted a little bit somewhat, given the recent price moves.
Yeah, I mean, everything has accelerated.
Yes.
And I think that, my feeling is that everything is just happening so quickly, and Donald Trump is now in office for just 1 year. We've got 3 more years. And I mean, what's going to happen in the next 3 years? I don't know. But in 2020, in Gold We Trust report 2020, we said we're expecting a golden decade. Back then, gold was really contrarian. Nobody liked gold. We said that our target, our base case scenario for gold at the end of this golden decade is $4,800. People said, you guys are crazy. It's never going to happen. But then we also said there's an inflationary scenario. So if inflation will be a concern in this decade, if it will be a topic in this decade, then our price target is $8,900. So we already exceeded our base case scenario in 2026. And we're right on track for this inflationary scenario target, which is 8,900 at the end of this decade. Now 8,900 still sounds extremely bullish, but that's a CAGR of 12.3%,
Yeah.
which is pretty realistic.
By the end of the decade.
By the end of this decade, yeah. So we kind of stick to that target, and the big call in our last In Gold We Trust report that came out in May last year
Yes.
was called the Big Long, and the thesis was now is the time to be overweight silver and mining equities, because until then actually silver has underperformed gold, mining equities have underperformed. So we said, like in cycling, silver and mining stocks will come out of the draft and really show big momentum. And I think that people completely underestimate, when momentum really kicks in, how dynamic it actually is. Yeah, and we've seen this dynamic in silver. I remember trading around 30 for ages. And then we took the 50 and then off to the races. Yeah, mining stocks developed tremendously over the last couple of weeks. And I think that the risk reward for silver is still a good one. I think for commodities, for mining equities, we're still finding some bargains. Yeah, we're still seeing like attractive valuations in some of the large cap names, even more so in the junior space. But I'm seeing the most attractive risk reward now in the commodity space. I think that's really, from a cycle point of view, I think commodities are next.
Going back to your $4,800 gold call that some people said was crazy. What did those people not understand? What assumptions did they underestimate? Let's put it that way.
I think back then nobody really talked about inflation. Back then, people, they don't think in cycles. And I went through one big, beautiful bull market, quitted my job at the bank, set up Incrementum with my partners. Then we went through a nasty bear market. Yeah, it took much longer than expected. But then at some point it was pretty obvious to me that we've seen the lows, and that we're gonna move into a big bull market again. Yeah. So I think back then inflation was really, asset allocators in the Western world, they're so accustomed to inflation being the least concern for portfolio construction. You've got a CFA, right?
No, I don't.
Okay.
I failed. That's why I'm
here.
talking to the people. Oh, okay.
No, I don't.
All
I
right.
just have a CMT, Chartered Market Technician. But I remember from CFA, level 1.
I did attempt to take it. I did not pass. And this is why I'm currently doing what I'm doing now. But anyway.
No, but I remember there was in the Schweser study notes, one line, it said, there's only one riskless asset class, U.S. treasuries. Yeah, I remember that. And I remember, I showed it in my presentation, a friend of mine who's actually a mentor. He's really like a great investor, great trader. He told me early on in my career, when we set up Incrementum, scare young investors out of bonds. And I wrote that down and I put it on a post-it, and it's sitting on my monitor, on my screen since then. Scare your investors out of bonds.
It's not even just a CFA, Ronald, and I'm glad you brought that up. It's every business school textbook that I've been exposed to. And even I remember when I was interning, I was preparing to work at an investment bank. I didn't get in. Again, that's why I'm doing this now. But, in the models, the risk-free rate is always assumed to be U.S. government debt.
Yes.
I mean, that's just, to assume otherwise is just nonsense. No one even thought, what else could it be? Nobody asked that question.
Yes.
It was a constant, like the speed of light. Nobody questioned what C was. Maybe today is different?
I think it's different, yeah. I mean, we can call it de-dollarization. We can call it basically emerging market countries actually now just want to be treated in a fair way. They want to be respected. This is where the growth is, where the savings rates are higher, and this is where the gold actually goes. Yeah. So if we're really questioning this paradigm that perhaps U.S. treasuries aren't risk-free, I think this is still, if you're going to a CFA conference, this is still very, very controversial. For me, being a student of monetary history, being a student of cycles, it's not something controversial. And from my point of view, the US is still on a relative basis more attractive than Europe, unfortunately.
Yeah.
But I think that if you travel a lot, if you go to India, if you go to China, if you go to the Arabic world, you can see, well, actually, the dynamic in those countries, you can see it, you can feel it, the optimism. It's just different to the Western world, and I think that many people completely misunderstand where the growth in demand is coming from. Again, more than 2/3 of the physical demand is coming from emerging markets, and I think for us as gold investors, it's extremely important to understand the importance of gold in those countries, because they're used to rubbish currencies. They're used to inflation being one of the main drivers for portfolio construction. We here in the Western world, we're basically, we've all been living through the great moderation, inflation rates coming down, yields coming down, this, kind of fairy tale world, yeah. But it has ended in 2022.
I was reading on CNBC the other day, the sell U.S. trade is here. Basically move away from U.S. assets. That narrative makes sense when you think about why gold has gone up. But then you think even one step further, well, Bitcoin is also a non-U.S. denominated asset. Why hasn't that performed as well? In fact, it's underperformed the stock market last year.
Yeah, well, Bitcoin is still trading around 90,000, and I've rarely seen so much bearishness, which, from a contrarian point of view, I think it's a good sign. People couldn't care less about Bitcoin at the moment.
Yeah.
And I can tell you there's like so much, how do you say, hate coming from the gold camp to the Bitcoin camp. We saw it previously when Bitcoin was hitting new all-time highs. Yeah.
Yes.
They were ridiculing the gold camp. I'm in the sound money camp. I like both. We're actually running 2 funds that combine gold and Bitcoin. We're rebalancing all the time. And this perfectly makes sense, yeah? Just have a look at the risk-adjusted numbers. I think you want to be in this environment. You want to be in hard assets, be it gold, be it Bitcoin, be it commodities. And again, we want to take the emotion out of that, out of the investments. And then I would say, I'm in the sound money camp. I'm not in the gold versus Bitcoin camp, yeah? But I think, the big question is now with this loss of trust in the US and this enormous volatility that Donald Trump is showing us every day, basically, will the United States, the US has been a destination for capital for 15 years. Will it become a source of capital? And there were some interesting developments. Korea, for example, said if you repatriate capital that is now allocated in US equities, if you repatriate it to South Korea, back to South Korea, you're actually getting tax incentives. Yeah. So if this large trade, capital flowing into the United States, if this is reversing, that's going to be a big driver. And everybody seems to be bearish on the US dollar. Actually, we haven't seen anything yet. This is not a major US dollar bear market. It's showing drawdowns between 35 and even 50%. So far, whatever index you want to have a look on, I think the Dixie, for example, it looks pretty strong actually, but then actually the majority of that kind of illusion is coming from the enormous weakness of the Japanese yen. And just very briefly talking about the Japanese yen,
yes.
I think there's a very, very high correlation at the moment between the yen and the price of gold. So we're watching the Japanese yen very, very closely. If it should reverse, I think that would be also some sort of headwinds for gold.
Yen correlated with gold, correlated with the JGB yield.
Yes.
Correlated with the USD yield,
Yes.
which is what we talked about earlier. So perhaps gold acting like a treasury alternative. Final question, and we'll end it here. Bitcoin versus gold. Which of these assets do you think has more potential in 2026, given their price pattern already?
Bitcoin.
Interesting. Okay, and why is that?
Because I think it's the reverse of the sentiment in the gold space. Yeah, I think if you have a look at Commitment of Traders report, it's not super extended yet. It's very bullish, but then actually attending conferences like here, everybody that I talk to is super excited about gold. And if I go to a cocktail party,
That's right.
people now want to talk to me. For some reason, yeah.
Well, you see, you study gold and Bitcoin, so everywhere you go, people want to talk to you. It doesn't matter what the market. You've hedged yourself very well, my friend.
No, they ask me, what junior mining stocks should I buy now? So I think, we're seeing quite a lot of optimism in the space, quite a lot of bullishness.
Yeah.
So I would hope for a correction, and it would be healthy. And Bitcoin is the opposite. I'm seeing extreme pessimism in the Bitcoin space, and again, people from the gold camp will hate me for that view, but I really like both. Yeah, I just enjoy the scarcity of gold and Bitcoin. Of course, Bitcoin is a monetary technology with a far shorter track record, but I think so far it's holding up extremely well, and it's within such a short time frame. It has become an accepted asset class, actually. Yeah, and I think that's a huge success.
I was at the Bitcoin Miami conference 2 years ago, 2023. Yeah, early 2023. And back then, Bitcoin was around 17,000. And I remember the hall was empty. And I remember thinking to myself, what happened? The previous year, it was at 69,000 and it was full. And it turned out to be the bottom for Bitcoin. So I think you're right. It's an interesting indicator. So let's see what this means. It's full today. I'm not saying that means anything, but
then again, I think it's primarily people that already get gold.
Yes.
I don't see at most of the conferences that I attend. I don't really see the generalists coming back. Yeah, this is a little bit like waiting for Godot. All the mining executives say, well, now the generalists are coming. Yeah. I don't see that yet, and just one final sentence, David, is and I think that's important for the whole gold industry, especially the mining companies. Just work over your slide decks, work on your narrative. People outside of our industry couldn't care less about geological results, drill results. Just show them how much cash flow you're producing, what you're doing with that cash. Show them actually what's your 3, 5, 10 years plan, and then deliver. But really dump down the narrative. It's too complicated. And people, if you're like a mainstream investor, you don't care about the geological details of a deposit. So I think this is really, if the industry wants to succeed attracting capital from outside our little mining bubble, then you really have to work on the message.
Okay. Well, congrats again, Ronald, for your excellent calls over the last year.
Thanks, David.
And never mind the crazy people. Never mind the people that thought you were crazy. I'm not saying they're crazy. I misspoke. But you turned out to be correct, and they were wrong. But anyway, let's see what happens in the next coming months. We're looking forward to your next In Gold We Trust report. When does that come out?
20th of May. It's actually the 20th annual edition.
Wow, congrats.
And the leitmotif will be the next 20 years.
Yes, okay.
So,
the golden decade.
The next 2 golden decades.
The next 2 golden decades. Okay, there's a little teaser. Okay.
Yeah.
Excellent.
It's not going to be easy, but
all right.
We'll do our best.
We'll follow up with Ronald then. Thank you very much,
Thank
Ronald,
you, David.
for
Pleasure.
coming back.
Pleasure. Take care.
Thank you for watching. Don't forget to like, subscribe, follow Ronald in the links down below.